Hello everyone, welcome to Quantitative Methods, the general overview of reading number 6, the time value of money. The time value of money is the first reading of the Quantitative Methods topic. It's a basic reading with a lot of foundation information you would need to go ahead and solve other quantitative method problems, and this reading is also useful for other chapters and other readings throughout the CFA level 1 curriculum. Okay, so it's a very basic fundamental reading. So the time value of money, the core information over here is that $100 today is not equal to $100 in the future. So let's say $100 in 5 years is definitely worth less than $100 today. Why? Simply due to the time value of money. Okay, accounting for the present value of $100 5 years from now, the present value of that amount today is definitely less, simply because if you save up a certain amount of money today, let's say $80, if you accrue interest over these 5 years, you would end up receiving the $100 after 5 years. So in that case, the $100 after 5 years is referred to as a future value, whereas the $100 today is referred to as the present value. Okay, so these two terms are very important, the present value and the future value. Now, these two terms work together with a certain level of factors. So let's start from the bottom over here, just to have an overview. So the present value is what you'll get, what you have today. Future value is how much your investment would be worth after a certain amount of time, the 5 years we gave as an example. These two have an interesting relationship in the sense that they move as a factor of other three inputs, which are interest rates, the payments, if there are any payments in between. In our example we gave, there is no payment, but let's assume that there were payments, $100 today and adding another $50 every month, then how much would you have after 5 years? The $50 per month in this case is the payment, and definitely the time, the factor of time. Definitely if you accrue $100 for, instead of 5 years, let's say 10 years, then your N over here is higher, is longer, and that means your future value would be longer. Okay, these are the 5 core inputs. Now what's so interesting about time value of money is that it follows the one equation, one unknown rule. So if you have 4 of these 5 inputs, you can just go ahead and calculate the 5th. How? Using your financial calculators. The CFA approved financial calculator is the advised or recommended calculator you should use, simply because you're allowed to take it with you in the exam. And that calculator, which is recommended to be a Texas Instruments Business Analyst 2+, you have to be able to use this calculator very efficiently, very fast, not only for the quantitative topics method, however, for all over the CFA level 1, 2, and 3 curriculums. I'm sure that talking about how to use the calculator right now is not very meaningful, since there are a lot of research material. You can simply Google and find out how to input these 5 factors within the CFA level, within the financial calculator. You can Google it, you can watch videos, it's all over the internet, so it's not very hard. Please master it. Okay, now we will already master it by simply doing our practice problems later on. However, meanwhile you need to master this. So our family of 5, present value, what it is today, what you have today as an investment, or what you should invest today. Okay, it could be either way, what you would invest, or what you would receive. Okay, it depends on which side you're looking at. So the present value, if you're taking a loan, for example, it's the money you're receiving today is the loan amount. So that's your present value today. The future value is how much that money should be worth after a certain amount of time. Okay, so the certain amount of time is meant by N, The periodic payment is if there are any payments in between. Okay, so if you save up $100 today and another 50 every month, as we gave an example, the $100 is the present value, but the every 50 payment dollar you do is the payment. Interest rate, everyone, is maybe the most important factor, since you would be discounting the future value. You would be discounting your future value using a certain interest rate. An interest rate within this concept, it's very essential to understand that it's a percentage, first of all, and it is the factor you would use to simply pull your future value to the present. That's an interest rate. We're going to do a lot of topics, a lot of practice questions about how to calculate one of these 5 factors using the givens within the 4 factors. Always remember, you have to keep your periods synchronized. So if you're talking about, if you're making payments every let's say month, and your N is 5 years, then your years, the number of years you're going to accrue is 5 years. However, with 12 payments every year, then your N is not simply 5, it's 5 times 12, okay, which makes it 60. Interest rates are maybe the core concept over here. This is a real factor that is required to really understand time value of money. Interest rates, however, could be used as a term interchangeably with other terms. Why? Because an interest rate is also the required rate of return. So if you're going to invest $100 over 5 years, well, you would require a certain rate of return since you're giving up your money. So required rate of return is another term for interest rates. The third term for that could be used interchangeably is the discount rate. The discount rate, why? Simply because if you have $100 after 5 years, how much is it worth today? Well, you would use an interest rate to calculate that, and you can also refer it to as a discount rate. The fourth terminology, which is also synonymous to an interest rate, is opportunity cost. Of what? Of current consumption. It's not expected consumption, it's not past consumption, it's the opportunity cost of current consumption. Now you have to know why. Simply because if you have $100 today and you would like to, you have a choice of either using it, spending it, let's say, you have a choice of either spending it or investing it, right? So opportunity cost of current consumption simply means that instead of consuming and spending that $100 today, you would simply invest it. So instead of investing it, you could be spending it. So how much would you return? How much would you gain from investing this $100 today? It's your opportunity cost of current consumption. Okay, always bear this in mind. Well, each of these 4 terminologies, interest rates, required rate of return, opportunity cost of opportunity cost of current consumption, and discount rate, are made up of different, if you want, components. Okay, these components are the nominal risk-free rate, the default risk premium, liquidity risk premium, and the maturity risk premium. Let's look into into depth of each of these 4 components. Now, well, if you're going to invest $100 in anywhere, let's say in a bank account or in a certain security or bond, first of all, you would require to receive a certain risk-free rate. The risk-free rate is the rate that any market participant investing in any security would gain anyway. Okay, it's there even if you invest in a risk-free investment, which presumably does not really exist in the real world. But even if you invest in such an instrument, if it existed, you would still receive a certain interest rate. Well, definitely, it's going to be very low. It's going to be extremely low. However, you would still receive it. Now, why is it nominal? Nominal risk-free rate includes 2 components within it. Okay, so the nominal risk-free rate is the general component. However, within this component, you have other 2 components, which is the real risk-free rate and the expected inflation. So The nominal risk-free rates includes real risk-free rate plus expected inflation. You would be receiving a real risk-free rate, definitely you would. However, on top of that, you would be receiving the effect of inflation, because as time moves on, goods generally get more and more expensive due to the effect of inflation, and that effect of inflation should be embedded within your interest rate calculation. Now, it's always expected inflation. It's never current, it's never past, it's always expected. Okay, so do not get confused, because when we were talking about opportunity cost of current consumption, we were emphasizing on the fact that it's current consumption. However, when you're calculating the nominal risk-free rate, it is made up of the real risk-free rate plus the expected inflation over the next period. So this is the first component, the nominal risk-free rate, and then we have to add to it certain premiums or premium. Premium means, well, a premium by itself, it has to also be include with it the word risk. So the more risk you take on with that $100 you have in investing it, the more risk, you would require a more interest rate. I mean, investing in a bad investment is not a good idea unless you make more money on it. So you would require a higher risk premium. Now, what are these types of risk premiums that are embedded within your interest rate? Well, first of all, the default risk premium. The default risk premium is basically the risk of that person you gave your money to not to pay you back. Okay, just a default on his obligation, where you're assuming to get your $100 back after 5 years. Well, guess what? What if he doesn't pay you? That risk is called the default risk premium. The action of that counterparty not paying you is called default by itself. However, the default risk premium is the premium, percentage premium you would require on to be embedded within your interest rate. The higher the default risk, the higher default risk premium you would require. Okay? The third component, everyone, is called the liquidity risk premium. Well, if let's say you're doing an investment in a real estate asset. Real estate assets, well, a lot of people say that they might be the best investment ever since they always appreciate in value, especially if they're land. Well, there's something about these types of investments that you can't easily sell, especially during market downturns. So let's say there's another subprime crisis. Let's hope it never happens. However, let's assume another subprime crisis happens and you want to offload your real estate asset. Well, no one's going to buy it. That idea of no one buying it is simply called a liquidity risk premium. So in order to account for that risk premium you're taking on, you would also require a higher rate of return. In other terms, you would require a higher liquidity risk premium. If you compare this to, let's say, a treasury bill, a US government treasury bill with a maturity of 1 year, well, anyone would buy that instrument. If you want to sell today, anyone would buy it on this second. Even during market downturns, these type of investments, which are issued by very well-rated, high credit-worthy sovereigns, well, these issuers have a very low liquidity risk premium, and you can simply sell it. So high liquidity of an instrument means a low risk premium, low liquidity risk premium. The lower the liquidity of an instrument, the higher the risk premium. Another component is the maturity risk premium. Well, this comes intuitively. As a matter of fact, if you had decided to invest over 5 years, you would definitely require a higher rate of return, simply because you're locking up your money for 5 years. However, if you decide to invest for 1 month, well, no one's really going to pay you that much of a high interest rate, simply because you're going to get your money back very soon. So the longer the maturity, the higher the maturity risk premium. So let's go ahead and talk about these very fast again. Default risk premium, the higher the default risk, the higher the default risk premium. Liquidity risk premium, the higher the liquidity of an asset or an investment, the lower the liquidity risk premium. Okay? And for the maturity risk premium, the longer the maturity, the higher the maturity risk premium. Always bear in mind this relation. Now, let's talk about annuities, an ordinary annuity and an annuity due. Well, first of all, before we talk about these two terms, we have to see what's in common between them. An annuity. What's an annuity? An annuity is any type of investment that pays out an equal size payment during equal sized intervals. So if you're investing today on a certain, let's say in a certain bond, and you're receiving $50 every month, then since the $50 is fixed and the time period of 1 month is fixed, then that's simply an annuity. Rent, let's say, is an annuity, since you're going to pay rent of an equal sized payment every month. So the payments are equal in size and the period is equal in size. So that's an annuity. Then what's the difference between an ordinary annuity and annuity due? Well, when these payments happen at the end of the month, it's called an ordinary annuity. When these payments happen during the beginning of the month or beginning of the period, they're called an annuity due. Let's say you agree with your tenant to pay rent after the month ends. Well, that's simply an ordinary annuity. Let's say, on the other hand, you agree to receive your salary, which is an equal size payment every month, and before the month, at the beginning of the month. In that case, it's an annuity due. So always know the difference between the two. Now, when it comes to calculating inputs, what's the difference? Well, the difference is that if it's an annuity due or an ordinary annuity, your input on your calculator should be synchronized. So putting these 5 inputs, when your calculator is on end mode, you have to use these inputs to calculate an ordinary annuity. However, if you would like to calculate an annuity due, then you have to shift your calculator to beginning mode, okay, to what we call beginning mode. Please know how to do it. It's very straightforward. Just enter changing the mode of the calculator. This is all you have to do, and then input the 5 factors, knowing that from the question that is presented that it's an annuity due. Now, a piece of advice, everyone: every time you calculate an annuity due exercise, please, before you jump to the other exercise, always shift back to end mode. I've seen a lot of students that forget their calculator in beginning mode and simply use beginning mode for all other questions, and which are usually end mode questions or ordinary annuity questions, and do everything incorrectly. So please always shift back to end mode. What's a perpetuity, everyone? Well, a perpetuity is similar to an annuity, except that annuities end at a certain date. I mean, you're not going to pay rent forever, right? Because you might not stay in that house forever. So there is a certain maturity for an annuity. However, a perpetuity has no maturity. It's simply equal payments, equal size cash flows, equal size periods. Let's say you're receiving payments of $50 every month. However, for how long? Well, they go on forever. You'll be surprised to hear a term like that, like a certain investment paying you amount of return every month forever. Well, there are a lot of instruments that are perpetuity in nature. Preferred shares, for example, are mostly perpetuity instruments. Well, perpetuity instruments are borderline between debt instruments and equity instruments, since they're very long-term in nature. So a perpetuity is something important. Now, there's something you have to know about a perpetuity. These 5 factors over here do not apply when you're calculating a perpetuity. What applies for a perpetuity is the formula below. Okay, we're going to take a look at it over here. So the present value of the perpetuity is the payment divided by the required rate of return, or the interest rate. So if you want to calculate the present value of a perpetuity, you cannot input the 4 factors and calculate the 5th. Well, as a matter of fact, there is no number of periods, so it's like infinity. Since that is the case, you cannot use these 5 factors. These 5 factors do not apply. What applies is this formula. The present value of perpetuity is the payment made every month divided by the required rate of return. Always bear that in mind. If you have, let's say, 2 of these 3 factors, you can calculate the third very easily, okay, through the one equation, one unknown rule. Now, another principle. Well, this principle is just something you should know. I doubt you would need to calculate this, but it's also called the cash flow additivity principle. So, let's say you have 2 streams of cash flows. The first stream of cash flow pays 2 streams of cash flows, and you would like to calculate the PV of them both. Let's say you do calculate the present value of these 2 streams of cash flows and you add them up. Let's say you get $100, adding the PVs of these 2 streams of cash flows. Well, if you add cash flows matched for each period of these 2 streams of cash flows and construct an aggregate stream of cash flow which includes both of these streams, and then calculate the present value, you would also end up with $100. Okay, so this is called the cash flow additivity principle. Again, it's not something that you will require to do, it's something you're required to know. Okay, so the PV of 2 investments, no matter how you calculate their present value, if you calculate the present value of each stream of cash flow alone, or if you aggregate these 2 streams of cash flows into one stream of cash flow, their PVs would be the same. Now, some key formulas. I understand that these key formulas could be, in most cases, could be used instead of the input, the calculator inputs, or maybe the calculator inputs using them is faster than these key formulas, but still you have to know these formulas. Except for the perpetuity, the calculator inputs just do not apply. Now, what's an effective interest rate or an effective annual rate? Well, as a matter of fact, let's say you agree to invest your $100 for 10% every year. So after 1 year, investing your $100 would return you an amount of $10, right? Well, if the bank tells you that, listen, the interest rate is 10% per year, however, I would pay you $5 the first 6 months, and the second 6 months I'll pay you another 5% for the remaining 6 months. So what's happening over here is implicitly they mean that they are compounding your 10% semi-annually. You would receive 5% interest during the first 6 months and another 5% interest during the second 6 months. However, the 5% interest during the second 6 months is based on the $105 and not the $100. So your effective annual rate would really be higher than 10%. Well, marginally higher, yes, but it would be higher. And the more you would compound, let's say if you want to compare monthly compounding to semi-annual compounding, then your effective interest rate would be even higher. Now, how can you calculate your effective interest rate? Well, simply put, let's say that it's a 10% interest rate. So the bank states that's the 10% interest rate. You put your 10% over here. 1 plus 10%, well, divided by number of periods. How many periods do you have? Well, semi-annually means you have 2 periods. So 1 plus 10% divided by 2, which is 1 plus 5% to the power, well, that 2%, you have to power it as well. Okay, so it would end up being 1 plus 5% to the power 2 minus 1. This would end up with your 10% semi-annual effective annual rate. Now let's do another one. Let's say it's 10% compounded monthly. Compounded monthly, well, it means that this is 10% compounded monthly, so that means 12 periods. So it's 1 plus 10% divided by 12 to the power, what? 12. Then minus 1, definitely to remove the effect of minus 1. So this is a formula you should always commit to memory. Please know this formula. It's very easy and you'll use it in a lot of places in your CFA level 1 curriculum. The present value of perpetuity, we already talked about it. Now let's talk about future value and present value. Well, if you have these 4 inputs, you do not need to calculate these through the formula, but I would like you guys to look at the key difference over here. The key difference is that future value is higher than present value. Why? Simply because, in mathematical terms, simply because we are multiplying the effect of compounding, which is this over here. We're multiplying the effect of compounding to our present value. So if you multiply a number to a certain number, the end result would be higher. That's why your future value would be higher than your present value. Now, what is the factor you would multiply by? It's 1 plus the periodic rate, which is, the periodic rate is nothing other than the stated rate divided by the number of periods. Okay, so this factor is also called the periodic rate. To the power number of periods. Okay, the same manner we calculated the components of the effective annual rate, you would use it to calculate your factor in your future value and present value calculation. So the future value is higher than the present value. Well, on the other hand, that means that present value is lower than future value. So if you have the future value and you would like to calculate present value, well, go ahead and just divide it. Okay, so over here you would divide. Since your future value is always higher than your present value, then you would divide by that 1 plus periodic rate to the power number of periods. Now, just for you to always know this in a very efficient manner, as the compounding periods increase from, let's say, semi-annual to quarterly to monthly to daily, what happens to the future value? The future value would increase simply because that this factor is increasing. So the more you compound, the more your future value would increase. However, the more you compound, the more your present value would decrease. Okay, since you're dividing by a higher number, over here a higher factor, and vice versa. So when compounding periods decrease, let's say if you want to compare a 6-month or semi-annual compounding to a monthly compounding, well, the semi-annual compounding is going to result to a smaller future value, a lower future value, simply because you're multiplying by a lower figure. And it would also lead to a higher present value, simply because you're dividing by a lower amount. Okay, always bear this relationship into memory, commit this relationship into memory. Okay, everyone, now this is a general overview. Honestly, I believe that there's nothing more to this chapter, to this reading, other than what we talked about. This is the basic information. A lot of maybe other information is available. I really advise you to go through the curriculum material in depth using your CFA curriculum books or other providers if you are using any other provider. However, it really boils down to this. Now, how can you do all of this? We're going to do questions, practice questions. So let's go ahead and start doing our questions.